Welcome to the Broken Pie Chart Podcast, episode 133. I'm your host, Eric Moore, and this week we have a very special guest back for appearance number 2. It's Marcel Benjamin. He is a fixed income strategist in the Spider ETF fixed income group, supporting the distribution of the firm's bond ETFs. And prior to joining SSGA, State Street Global Advisors, that is, Marcel was an investment strategist at Swiss Re. Also, prior to that, he was a portfolio manager and trader at Guggenheim Partners Asset Management. Began his career in fixed income portfolio management and advisory at BlackRock. In addition to holding a undergraduate degree from Penn, also has an MBA from Columbia Business School, and is a CFA charter holder. And so, Marcel, thanks for coming back on. Welcome back on. You made it back, episode number 2.
Thank you. It's a treat. Thank you for having me.
Yeah, I'm looking forward to this episode because we got great feedback on the first one, and I'll link to it in the show notes if you haven't caught that yet. Marcel gave a sort of a master class in high yield fixed income, and so I encourage everybody to listen to that. And hopefully, we'll do the same with this episode. Marcel, I know with an inflation in the news, and I separately address that. We won't really talk about directionally what inflation will do on this podcast, but a lot of people are looking at Treasury or TIPS, Treasury Inflation Protection. I couldn't think of the word for a second, bonds. But also, we're in a very low yield world right now, which has some additional sensitivity to interest rates. And so, really, Marcel, I guess I want to start there. And I think sometimes it's one of those things that's a little misunderstood when we think about duration. You and I think about it, and you especially being an expert in the fixed income world, think about duration as sensitivity to changes in interest rates, not necessarily the maturity. So maybe we start there, Marcel. Like, talk us through, how does the coupon, actually, let me not talk. Let me just let you talk. Take us through what this means with duration and sensitivity.
Sure. So, when you think about a bond, the bond is typically just a series of cash flows. Right, it's a bond is a note, a loan of sorts, and as the owner of a bond, you have a series of cash flows that you expect to receive. And typically, those are known. There's some reasons which we won't get into about why you may not get those cash flows when you expect them. But for the most part, if you think about a treasury bond, you expect to get a coupon, typically semi-annually, twice a year. Of course, it could be more frequently depending on the structure of the security, but for a treasury bond, twice a year, it'll pay you a coupon. You know what that coupon will be. And then at maturity, you'll get your principal back. So with respect to duration is price risk or price sensitivity. And for most of the fixed income universe, it tends to be the main risk factor. And of course, there are other risk factors for different types of securities. But in the treasury market, this tends to be the main risk factor. And so if you think about a 10-year treasury bond, a 10-year treasury bond, 10-year because it matures in 10 years, the current on-the-run 10-year treasury bond, meaning the one that the market is now thinking of as the main 10-year treasury bond, because the government is constantly issuing, and within a month or a few months, there will be another on-the-run treasury bond. But currently, it's the treasury bond that matures in August of 2031. So it's actually slightly less than 10 years to maturity, about a month less than 10 years to maturity. It pays a coupon of 1.25%. And so I believe they're issuing monthly. So I believe that's going to change soon, monthly or quarterly. I don't know off the top of my head, but this bond was issued a month ago. It was issued on August 16th. And this is the on-the-run treasury bond. So if you think about what the duration of this security is, it matures in 10 years. Depending on your analytical provider, the duration is about 9.3, let's call it. And so why is it 9.3? Well, and what does that 9.3 represent? So most of the risk around the cash flows here is when you get your principal back, because it's only paying 1.25% along the way. So you're not getting a lot of cash flows between now and maturity as it relates to the principal. When those coupon payments tend to be a bit higher, you will see that the duration is less. And you have to think about this kind of like the fulcrum of a seesaw. If you think about when you get the cash flows along the way over the life of holding this security, if you have higher coupon payments, the fulcrum of the seesaw will be pulled to the left. For a zero coupon bond, the bond that pays no coupons and just matures, just pays the principal back at maturity, that typically you do see that the maturity and the duration are identical. So a 10-year zero coupon bond has a duration of 10. So what does that duration number mean? What does 9 or 10 mean? Well, it means that if interest rates rise 100 basis points or 1%, a basis point is 1/100th of a percent, then you will lose in price that 9 or 10, 9%, 10%. So today, that Treasury bond that I just described that was issued typically at par, so it was issued, actually it was issued at a discount to par, it was issued at 99 and change when it was issued in August, is still trading around 99, it's actually trading around 99.75. But if interest rates rose 100 basis points today, then you would lose 9.3% of that price. And in a bond that's trading at 99.75, let's just call it 100, that bond will go from 99.75 to 91 and change. 90. Yeah, 90 and change. And so that's your risk. It's your price risk. Bonds can lose price. And the bond will still mature at par, assuming, obviously it's Treasury bond, so it's about as riskless as you can get. But you will suffer that price hit today. And then over time, the price will slowly accrete back to par because the bond should mature at par. So it's kind of a long answer, Derek, but I did want to go through that step by step.
No, I think that's great. And one of the things I think it's important as I'm listening to you and picking things up here is with rates as low as they've been, it's a situation where duration goes up. And so maybe, we'll touch on that a little bit. And one of the points I wanted to come back to on this too, is you talked about a series of cash flows. And, just thinking about a 1% 30-year bond, that means on one bond, $1,000 par value. I mean, over 30 years, pretty much you collect $300 in coupon payments. At 10%, you collect $3,000. So literally on a 30-year bond at 1%, you'll get 30% of your par value in coupon payments, as opposed to 3 times your coupon payment. So does that play into it as well with the sort of the calculus around duration?
Yeah. So the on the run 30-year Treasury bond matures in 2051. It pays a coupon of 2%. The duration there is about 22.75. Let's call it 23. But 30-year Treasury bonds are quite risky because if interest rates rise 100 basis points, which of course they can, not instantaneously, that's obviously a rare event, but over the course of 6 months or a year, it's certainly possible. And that bond today is trading at 103 and a half. You will lose 20%. Now, there's something we didn't touch on called convexity, which is an adjustment that will help dampen some of that. And long Treasury bonds do have a lot of convexity, and I'm not sure if I'm going to get into that. It's the second. It's the rate of change of duration with interest rates. So it's a second derivative, and I know once I say derivatives, in this case I mean second derivative, like from your calculus class. But once I say that, I know that bond math does tend to get pretty complicated pretty quickly. But regardless, let's just say you lose 20%. That's a lot. That's a lot to lose, but it does happen if interest rates rise. So there is interest rate risk in the fixed rate bond market, and most core bond portfolios are nearly entirely composed of fixed rate corporate bonds. Certainly the Bloomberg Aggregate Index has a requirement that the bonds be fixed rate, and floating rate bonds are excluded. So that is the main risk factor, I would say, when you're investing in traditional core bonds.
By the way, certainly we would have an audience of probably 2 people if we did a deep dive into convexity. And heck, I don't know how to do that without visuals. But let me know, Marcel, if I was given this example the other day. I said convexity is kind of, I described it. I was up near Fenway Park one time in Boston, and there's a pub outside called the Cask and Flagon, and people wait in line to get in the morning on like a Saturday. And then my example here, let me know how what you think of this analogy, Marcel, is convexity is kind of like people go in when the bar first opens, everyone orders a lot of drinks, and then they order a lot of drinks right before they leave for the game. And it's that the edges that curve up, they're sort of convex. That's how I explain convexity. How'd I do, Marcel? No?
Yeah, no, I like that.
Okay.
We convexity is also associated with optionality, and you know, if you think about options, you know, most people are familiar with sort of the payoff on a stock option. You know, those have positive convexity, and so you know, when you're thinking about something with positive convexity, it's usually you know, you can be thinking that's good, that it's in your favor. Certainly, it is in your favor when you own these 30-year Treasury bonds, because as interest rates rise, your model tells you you'll lose 30%, let's say, but then there's the convexity offset, which means that you'll lose a little bit less than that. And if interest rates fall, again, the model is telling you you'll make 23%, but the convexity offset actually says you'll probably make a little bit more than that. And so it's good, right? Because that volatility is actually, you know, the convexity factor actually helps you. Similarly to options, right? Options do well, you know, all else equal, and volatility increases. And not to get too much off topic, but if you own a agency mortgage-backed security, then you have negative convexity because you've implicitly sold the interest rate option to the borrower on the home, on that mortgage that, you know, is pooled into your security. And so, well, what does that mean? Well, if you have a home, you can prepay your mortgage when interest rates go down. And when interest rates rise, you could decide to just pay the bare minimum. And to the extent you were paying off a little bit more on your mortgage, you say, well, why would I do that? I could put it in the bank. Interest rates are 5% now, and my mortgage is 3%, right? So mortgage owners have that flexibility, mortgage borrowers, I should say, and the investors who own the mortgage-backed securities have negative convexity. Now, to try to get back to sort of layman's terms, well, what does negative convexity mean? It means you kind of get hurt both ways, because if you own a mortgage security and there's a lot of interest rate volatility, interest rates are going up a lot or down, then those tend to underperform. So we talk about negative convexity as something where you know, your upside may be limited and your downside sort of increases and continues to increase. So, you know, if you're faced with a tough decision, you know, at work or in your personal life, and you feel like, man, damned if you do, damned if you don't, maybe you could say that decision that's a negative convexity decision or trade. But
yeah,
I also like your baseball.
I think no, it's convexity is one of those things. A lot of people won't talk about it because it's very complicated. And by the way, guess what it is? It is, as you said, it's sort of another derivative. By the way, to just thinking about while you were doing that, I went into my quick calculations, and to put sort of a number on this, and please correct my math if I've made a mistake here. A 30-year bond issued, let's say, you know, tomorrow, with a 10% coupon, I had about 9.5 to 10 effective or modified duration. And then I think at the beginning of our talk, you said the on the run 30-year was around a 24 duration. So kind of that's an interesting spread of how much more sensitive at low rates just using a 30-year is, right?
That's right. So if you have securities that pay high coupons, and we can get into why a security might pay a high coupon, then as an investor, you're getting a lot of cash flow along the way before your maturity. And so that shifts that fulcrum, more to the left, more to sort of the middle. And you may also have a security, again, to get into mortgage-backed securities, or just to use that for reference, where maybe it's not just the coupon you're getting along the way, but you're getting some principal payments along the way, because investors in the mortgage-backed market, even by in the base case in day one, they know that they're getting interest in principal every month, because that's how a mortgage loan is structured, right? When you pay your monthly mortgage bill as a homeowner, you're paying both interest and principal. And so on the other side of that, when that goes to the bank or the mortgage servicer, and ultimately it may go into a mortgage investment pool that maybe in one of your bond funds. There again, they're getting coupons and principal along the way by the base case, plus any prepayments, and whether that's a full refinancing of one of the loans in the pools, or maybe just as the borrower, you put in another $1,000 one month to your mortgage, whatever it is. And so there again, mortgages, even though they are 30-year term, mortgages typically are a 30-year instrument, because principal and interest comes in along the way, the duration there is much shorter. Maybe assuming no prepayments, somewhere like 8 or 10. But yeah, so it's really about those cash flows. When am I getting those cash flows? How much of those cash flows am I getting? Those really determine, that duration calculation. And in your case, when you said 10%, that's a very high coupon. But it does explain, for example, why if you have a 5-year investment grade bond and a 5-year high yield corporate bond, why the high yield bond will have a lower duration, because typically that high yield bond will have a higher coupon and yield. And so you're getting more of those cash flows earlier. And so, when we think about the high yield corporate market, which I talked about when I was on your guest last time, the modeled duration there is really somewhere around, 4 or so. It's also a function of those maturities, but when you do have higher coupons, you do have, shorter durations. Now, the trend in the market generally, broadly, is that coupons have come down because interest rates have come down. And so one thing we see, for example, if I use the Bloomberg corporate bond index as a reference, is that the duration in the investment grade corporate universe today is approaching 9. And some might say, well, let's look at the maturities. Are issuers issuing longer term debt? What is the composition? What is the average maturity of a corporate bond in the market? And there may be an element of that, but I would think that mostly it's a function of the fact that yields are lower. Therefore, the coupons on these bonds are lower. And if I look back to say, whether it's 2003 or 2006, or even briefly in 2009, the duration on that was around 6. Today it's approaching 9. So we have seen an increase in duration, or a lengthening in the duration of the investment grade corporate bond market.
No, I think that's a great point. And it also speaks to the things we've been talking about is the duration, your sensitivity to interest rates has gone up at the same time, coupons are going down. I don't want to derail us completely, but I was just thinking, my Excel formula breaks when I try and put in a negative yield to maturity. I hazard to ask, but 30-year bond with a let's say a 0 coupon, negative yield to maturity, negative yielding bonds. Let's just keep it simple. Am I correct that duration is above the actual maturity duration, above 30 years, or is the math just broken there?
That's a good question. So if you have a zero coupon bond with a maturity in 30 years, the duration, I believe, should still be 30, even if it is negative yielding, meaning even if you bought it at a price that is higher than par. Here it's a pretty simple example. When you have a bond that matures and gets par in 30 years, anytime you pay more than par for that bond, or anytime you pay more than par or 100 for any bond that has no coupons and delivers only 100 at maturity, you're going to have a negative yield. But your interest rate risk, your sensitivity is still the same there, I believe. So I'm not sure exactly what's going on in your Excel, but I don't think that would necessarily changed. The negative yield simply is yield is another way to express the internal rate of return, or just your return holding an instrument, a security.
I got the dreaded number sign num exclamation point in Excel. Anybody who uses that knows that it doesn't like my inputs for the output. But yeah, I mean, in a lot of ways, negative yielding bonds, it's sort of like it's almost like owning an option. But anyway, I don't want to derail us. Let's get to inflation a little bit, and what I think is a very misunderstood sub-asset class in the fixed income world, and that's the TIPS, the Treasury Inflation Protected Security. There's a lot of moving pieces to this. And so one of the prime reasons, well, I always want to have you back on, Marcel, for your fixed income expertise, but I wanted to dive into this a little bit. So first, can you just explain maybe, what a TIPS bond is, how it gets adjusted? Well, what a TIPS bond is, and maybe we can go into, in theory, what the adjustments are that's supposed to happen based on CPI there. Let's start there.
Absolutely. And, before I go into that, I just want to draw the attention of the audience to the fact that, this is a market that's, obviously that you're buying bonds issued by the US Treasury. There is the ability to buy retail allocations as well. I believe, something to the order of, you can buy, $10,000 as an individual basis for, each individual in your family. I don't know the exact details, but this is a market that is also a retail market, and that the government, is supporting as a retail market. So obviously, the government has issued, well over $1 trillion. There's well over $1 trillion of TIPS outstanding, and doesn't expect mom and pop to be supporting that market. But there is some portion of TIPS, Treasury Inflation Protected Securities, where they support individual investors, buying some, much like savings bonds, if you think about them like savings bonds in that regard. And so my point in saying that is that there's a tremendous amount of information online about TIPS, treasurydirect.gov, for example, a lot of websites with .gov. And of course, all the asset management firms also have primers and information on understanding these securities. But let me address that. So your question, so TIPS are an obligation of the US Treasury, and they differ from regular Treasury bonds, which are called nominal Treasuries. They differ in a couple of key ways. First of all, the TIPS market is smaller. Like I said, about $1.5 trillion. Obviously, the US Treasury market is many trillion. Newer, the first TIPS bond was issued, I believe, in the late 90s. So maybe that doesn't seem that new, but if you think about high yield corporate bond market, and Milken and all that going back, that obviously that's an older market than the TIPS market. So that's important to think about. These are a class of securities that are global. So in the UK, they have linkers. There are a lot of different types of inflation-linked government securities worldwide, and that's something to bear in mind as well, that we're not unique in the US in this asset class. But the way that these securities are structured, they still have their regular coupon payments semi-annually. They have their principal at maturity. But the key difference here is that the principal adjusts based on inflation. And I don't want to get into the nitty gritty of the formula. It's a CPI. It's a certain type of CPI because there are many different CPI numbers that are reported every month. I believe there's a lag embedded there as well. But the gist is that the principal value adjusts with inflation. And so your return as an investor when you buy the securities, not just the coupon and the principal, and an unchanging principal that you would with a nominal treasury, but it's the coupon on a principal that adjusts periodically. So that coupon could be slightly more or slightly less, because if you have a principal that's par or 100 and you're getting a 1% coupon, but in a year it's 101, then you're getting 1% of 101. So that's important to think about that math. You do get a coupon that in some ways varies because the principal varies over the life of the security. And then at maturity, you get this principal that is typically higher and has increased. And that is a key component of the total return of owning this security.
So I was going to ask, just thinking about this, right? So a bond comes out, $1,000 bond, and actually I'll have some questions later because there is some nuances at auction or at market. But a bond comes out at $1,000, and depending upon the CPI, it's going to adjust up if the CPI goes up, and then also if its coupon is set, its coupon then is calculated based upon the new price, right? I think that's what you were alluding to in the discussion on some of those nuances, right?
That's right. So the coupon payment that you get is the fixed coupon times the principal value for a nominal treasury. But for TIPS, for a Treasury Inflation Protected Security, it's the coupon on the principal value that typically has been adjusted upward at every point when that coupon is paid. Now that's subtle because these don't increase that much. Let's say if you have 2% inflation, you paid $1,000, now you're at $1,020 in terms of principal, and you're getting 1%, right? So it's small, but of course, by year 5, your principal may be up to $1,100, and so your coupon at 1% is going to be, instead of $10, $11. So it's just important to understand that nuance, that the coupon is calculated as the coupon payment times the principal. And for a regular treasury or a regular corporate bond, that principal doesn't change, that notional amount. But in this case, it does, because the principal is adjusted as these CPI inflation numbers come in.
The flip side, I guess, is we haven't had sustained deflation, but we have certainly around recessions had where CPI has negative year over year, month over month change. So the opposite is true, correct? With deflation, you could have the bond lose money, correct?
That's right. The principal, in a given month can be adjusted upwards or downwards. There is one very important footnote to that, which is that the government has decided with this class of securities that at maturity, you cannot get less than the issue amount, the amount that was issued. So you're basically floored, or you can think about it as an embedded put option. But the government says, I issued 1,000 of these to you, right, or into the market. And in 5 years or in 10 years or in 30 years, when this security matured, you will get no less than that 1,000 back. So you don't have to be worried about, deflation, persistent deflation, eroding the value of that security over the life of the security. Now, if you buy it, 2 years after it was issued, and then there's deflation for the last year, and it's a 3-year treasury, yeah, you can still suffer that. But again, the government is saying we will always give you back that 1,000 that we issued it at, and that's important. You're right. We haven't really seen a prolonged or persistent bout of deflation, but it is, and so maybe it's not that relevant to investors in this market, but it is it is a nice little nuance and benefit of the asset class.
I think one of the key things you mentioned there too, when thinking about the risk side of this, and it's always important for investors to be evaluating that, as you said, if they buy it, let's say at auction at par. So if you buy it at 1,000 and it goes down to 800 because you've got a bunch of deflation, they're saying, well, we'll let you redeem it at maturity at 1,000. But as you said, I mean, if you go into the marketplace and you buy this for 1,100, there's no guarantee of keeping your 1,100. They say, well, if it goes below 1,000, you'll get 1,000, but you still lose 1,100 to 1,000. And the other thing too, I should have pulled up this data, but I did notice that I was watching some of the auctions and there was oversubscription for the auctions, where the people were paying at auction more than 1,000. So I think that's an important distinction. It's a very good feature, but there are things to watch out for, right, as to whether or not you actually get to take advantage of that.
That's right. The TIPS market reflects investor expectations around inflation. So one of the things that, again, to contrast it with a nominal or regular Treasury bond, is that when you buy a Treasury Inflation Protected Security, let's say you buy it, at issue, or anytime you buy it and you decide to hold it till maturity, you don't actually know what your return is going to be. You need a crystal ball, right? You need to be able to know with certainty what those CPI prints are going to come in at along the way and over the life of the security. And so your cash flows, in a way, are unknown. Now, they shouldn't be exceedingly mysterious, right? This isn't, there is some way to predict that, and there is some degree of certainty that you can have around that. But if you buy a 30-year Treasury Inflation Protected Security, that's when it gets really complicated, because what are the inflation numbers going to be in 2042 and 2046, right? So investors do tend to prefer to invest in shorter maturity or duration TIPS sometimes, because they feel, whether it's correct or not, that they have a better handle on inflation in the near term and inflation expectations in the near term. Now, this market prices in inflation expectations, and is also, if you think about it, because I describe this as an obligation of the Treasury, when you buy a 5-year TIPS security, a 5-year inflation protected security from the government, or a 5-year nominal security, your yield profile shouldn't be that different, right? Because you have many similar risks. And so the difference in those yields, the TIPS yield is called the real yield, and the Treasury yield is called the nominal yield. The difference between those, just pure subtraction for two of these securities with the same maturity, is called the break-even spread. And that's something you can actually plot and track and look at. And some investors like to trade that as a range and look at that relationship as a range. But that is sort of the expectation over that period. 5-year break-evens would be the expectation around inflation over a 5-year term. One of the things that some folks may miss if they are just casually investing in the TIPS market is that TIPS still have duration risk. They still have interest rate sensitivity, and that can be significant. Although, as compared to an equal maturity Treasury, the interest rate sensitivity, the duration tends to be lower or dampened, even though the coupons are lower. And so that is sort of contradicts or maybe unintuitive based on the conversation we had earlier. The coupons are lower, but the inflation component tends to be a dampener for empirical or observed duration that we see for TIPS as compared to nominal Treasuries. But they still have interest rate risk. And so if you buy a TIPS security and interest rates go higher, you will do better than owning a Treasury security in most cases, but you may still lose money. You may simply lose less. So it's important to understand what the duration is of your TIPS bond fund or your TIPS security that you've purchased.
I think that's an important point, Marcel, and that maybe a lot of folks out there might be thinking, well, if interest rates go up, inflation goes up, and the corollary or there's a high correlation to interest rates, I'm protected. But you mentioned earlier, a lot of people don't like to go out that far on the maturity curve. If you buy a 30-year TIPS bond and you have an interest rate rise, I think it's a really important point. You've still got that interest rate risk, but you do get, so if your interest rate, if the change in the bond due to interest rates is greater than the inflation adjustment, you're losing money. And I think the way you put it is dampening the losses because inflation is going up is a good way. But I think it's a really important point to stress.
That's right. So if you think about the real yield and the nominal yield and that break-even spread, if interest rates are rising, meaning nominal yields are going up, typically, but not always, that means that there is some association there that the market is also saying, well, interest rates are rising, inflation is or will also increase. And so the interest rate on the nominal treasury increases, the break-even spread also increases, and so the yield on that TIP security will increase, but increase a little bit less because it's a function, right? It's just arithmetic here of the nominal treasury yield and the break-even. So it's a little bit complicated. It does get a little bit unintuitive because when break-even spreads increase, it's actually a good thing. When credit spreads increase, it's a bad thing as a bondholder. So it does get a little bit complicated, mainly because the yield on the TIP security, the real yield, is lower than the treasury yield, whereas the yield on a corporate bond is higher. So we're going the opposite direction. But obviously, when yields fall, that's your friend, whether it's a TIPS or a nominal bond. And so that break-even spread, that relationship is important to also kind of have a handle on, to understand, to look at that historically, and understand when you're buying into the TIPS market, what is the implicit break-even that the market is pricing in. And those break-evens have increased, pretty dramatically over the last several months, and certainly in 2021. Those numbers do go negative. Typically when there is a sort of a dramatic sell-off, a recession, whether it's 0809 or March 2020 or other times in the last decade or so, we do see those break-evens can go negative, meaning the market is expecting disinflation or deflation, which you do tend to see around a recession.
I started off the conversation by saying it's a misunderstood asset class and it's more complicated than you think. And I think it's true. It's true. I mean, these have a lot of other factors involved. And so I think that's an important point. I want to get to maybe the decision of, am I better? And I want to be clear. I mean, we're not looking to give you a recommendation, or certainly I'm not giving you any recommendations on this, but I think there's an evaluation of, and like everything so far, it's a little more complicated than you might think. I mean, when I look at the 10-year treasury yield, and I'm going to round off where it's about 1.3%. If you bought a treasury today, you get about 1.3% annualized over the next 10 years. If you bought a TIP at par, I don't think they can go below a 0.25% interest. But the break evens are not, 1.05, Marcel. They are higher. Is that because the auctions are going off at negative yields maturity, meaning people are willing to pay more than par? Maybe we should explore that a little bit. Dig into that, how the break even is actually calculated, why it's higher than the difference in just the coupons. Does that make sense?
Sure. So first of all, in the TIPS market, one of the things that the government has done is to floor the coupons at 1/8 of 1%. So the other thing about this this
Did I
market
misspeak, Marcel? I think I did. I said a quarter point. You're right. It's
no, that's fine.
0.125. Thanks for pointing that out.
Yeah, we're splitting hairs here, an eighth of a percent. But one of the things about the TIPS market is that it's I mentioned it's relatively small, $1.5 trillion, which again, vis-a-vis the corporate bond market, the treasury market, the mortgage market, those three largest components of the AGG. It's relatively small. It's not part of the AGG. That's important to note. The TIPS market. So if you invest in TIPS in a core bond portfolio, you are making an ex-AGG bet, a bet outside of the aggregate index. But at $1.5 trillion or so, and we should also get into the fact that TIPS have been part of the purchase program by the Fed, so the Fed owns a hefty portion of the TIPS market today. But there aren't that many securities outstanding, and so right now, in terms of TIPS securities in the market, there's less than 50 of them, less than 50 of those bonds. But when you buy one of these securities, because that coupon is floored, they've decided that they're not going to issue zero coupon bonds. Obviously, there's no such thing as a negative coupon, really. But they've decided to put that coupon, at 0.125%. But the real yield, meaning the yield assuming no principal increase over the life of the security, is negative because, again, it's the nominal treasury yield minus the break-even expectation. So that real yield may be negative, and then as an investor, you accept that negative yield because you know that you will also have the principal, or you hope or you expect that the principal will increase, and then the total return of the security over the life of the security should be similar to that of a nominal treasury. And there again, there are a couple footnotes why those yields may be different. Well, first of all, there is some uncertainty, right? So maybe as a TIPS investor, you may say, I want slightly more yield than a regular treasury investor because of that uncertainty. Two, the TIPS market being smaller is somewhat less liquid. Treasury bonds tend to trade with very small bid asks in normal markets. TIPS bonds do have slightly wider bid asks, and that has to do in part because they are difficult to hedge for the broker dealer community, because inflation is one of the driving factors. So I've never been a market maker in my career, but I've heard that sometimes they are hedged with oil futures and other types of securities. But regardless, they tend to be less liquid. So you may, as a TIPS investor, demand a little bit more yield for that liquidity premium. So there are a few small factors which, sort of stray away from that basic arbitrage notion of, two 5-year bonds issued by the US Treasury should have the same yield. One is a nominal and one is inflation protected. In reality, the TIPS market may demand a slightly higher yield for some of the factors that I laid out. But regardless, you have that principal that you expect to increase over the life of it, and that is a key driver of your total return, and that's why you see these negative real yields at issue.
Marcel, just looking at the break-even rates, I know I referenced 10 years earlier, but I had the 5-year break-even up on at the ready, and they're around 2.5%. So if I look at a break-even of 2.5%, is that a good indicator as if inflation is greater than 2.5%, I would be better off owning the TIPS bond of the same maturity? If it's less than 2.5, I'm better off owning the nominal, just 5-year normal treasury. Is that a good way of looking at that?
Yes, that is a good way of looking at it. And if inflation expectations come in below what the market is pricing in today, you will have been better off owning that treasury bond, not the inflation protected one. And the other thing to think about is what has been the range of that break even. And so I do have the benefit of having a Bloomberg terminal, which is an incredible data source at my fingertips. And if I look at that 5-year break-even rate or spread, and I look at that today, you're right. It's around 2.5. It's been around 2.5 for a few months, and in March 2020 it got to just above zero. So at that point, the market was saying, "Wow, this pandemic and this uncertainty and this dislocation, we don't really expect inflation for the next 5 years." In late 2008 or so, it did go negative. But if I look at the average, the daily average over the last 20 years, according to my Bloomberg terminal, it's 1.84. And some investors may, massage that data and say, well, the March 2020 was obviously the markets were in disarray. Similarly, in late 2008, maybe we would kick out some of those negative data points. Clearly, it seems, it seems that investors probably weren't necessarily expecting negative, 1% inflation for the negative 1% deflation for the subsequent 5 years back in November 2008. Maybe that was really just a market dislocation. And so you might want to kick out some of those numbers in the data set, and maybe that would push the average a little bit higher. But the market historically over the last 20 years or so thinks that inflation over a 5-year period is around just shy of 2% a year.
Yeah, so it's interesting too, and beyond really the scope of this discussion, but when I think about the bond market's pretty good, Marcel, at I don't want to say making predictions, but the bond market gives investors on whole a pretty good clue about what it thinks about inflation and about rates going forward. And the bond market is a voting machine, right?
That's right. Like many markets, or I guess it's Graham. Was it Graham Dodd or Buffett? They call it a voting machine, not a weighing machine in terms of value. I also looked up the 2-year break-evens, and there maybe investors can think about, well, what is inflation over the next 2 years at any point in time? It did go negative in March of 2020. I guess investors were saying I could envision a 2-year period of deflation. Back in 2008, that number was -6 at one point.
Wait, -6, not 6 basis points, 6%.
They were saying 6% deflation for the subsequent 2 years. Now, again, I think that is a function of what was happening back at the time. Investors were dumping securities willy-nilly. There was such a need for liquidity. And so that there's probably some technical dislocations there, some price. It wasn't necessarily investors making that assessment, but that's what the market said. I mean, investors who bought tips in December 2008, probably did well. Of course, you could say that about a lot of different asset classes being bought around that time period, recovered in value. So obviously, when investors, traffic in the tips market, there is relative value across other asset classes. Obviously, there are specialists who just trade tips and invest in tips, but every asset class that needs to be considered against another asset class in terms of risk reward. But yeah, so that 2-year number may be easier for some to sort of think that they have a higher degree of certainty around making those predictions. But that average, again, 20 years back, around 1.5%. And so within the 5-year number that I quoted just before, there is, of course, that 2-year number. And then there is the remaining 3 years, what we call the 3-year inflation rate 2 years forward. So the forward inflation rate. And that gets a little bit complicated because I'm talking about an expectation that's going to happen in the future, about a period in the future. But that's kind of how that bond math works, right? If you've got 2% for 5 years and you've got 1.5% for 2 years, that means you're going to have more inflation over the subsequent period because they all have to equal each other when you multiply them by each other. So something to keep in mind. There are this notion of not just inflation expectations today, but forward inflation expectations, and what is the market pricing around that?
Part of me says I shouldn't go there because I know we probably only have about 10 minutes remaining, but I'm going to go there. The five-year forward inflation expectation rate is something that's thrown around a lot, but very few understand this. Like we just went over a 5-year break even. And so maybe we could try and simplify that a little bit. And basically, right, the five-year forward inflation, can you explain that? I mean, I always look at it as sort of the difference in, rates starting 5 years in the future, right? So let me try this first, and you can clean it up for me. So the five-year forward is saying in 5 years. So it's almost like, what's the rate going to be from year 5 to 10 in the future? Is that a good way of putting it?
I think that's right. Yeah, I think you nailed it.
Okay.
and again, sometimes there are opportunities in that market. It's not an easy market to play in. Typically, based on my understanding, it's really a swap market. Investors, can invest or speculate in that market based on inflation swaps, and that's another market. But I mean, there may be opportunities based on current inflation expectations. You look at what is the 10-year inflation expectation today. You look at what is the 5-year, and the difference there is the 5-year forward. The expectation in 5 years for 5 years, from year 5 to year 10. And sometimes there are inefficiencies in that part of the market. But yeah, I mean, I think the Fed actually does look at some of those markets, and those expectations do matter. But I think we're probably straying a little bit here in terms of I don't want to overcomplicate this conversation.
Let me bring it back, and I made a note of something that you said very briefly, but I think it's worth repeating, is the Fed participation in this market. I think I read somewhere, it might have been J.P. Morgan or Goldman had a piece out that the Fed now owns over 30% of the total TIPS market. I don't know if that's still accurate or not, but I think that's important. I mean, the Fed coming in, that's a lot of demand that they've sort of added to that market. I don't know if you have any thoughts on that, or if not, we can sort of move on to something else. But you mentioned it in passing, and I wanted to come back to it.
Yeah, so I do have some numbers around that based on Bloomberg index providers. So if we think about, I said there's about 47 TIPS in the market that are outstanding. Typically, when these indices are constructed, they begin at 1 year to maturity. So there are 3 of these TIPS securities currently that mature in 2022. They're not necessarily eligible for these indices. I'm not sure if the Fed owns some portion of them, so we'll take them out for now. Currently, so when you think about index providers and indices that are constructed around these asset classes that the Fed has become involved with, there's a notion of building the same index and excluding the bonds that the Fed owns from it, and that's called the float adjusted index. And you'll find that in the mortgage market. And now, of course, for the first time with the Fed owning corporate bonds in small amounts, you can make a float adjustment for the corporate bond market. But for the mortgage market, that's been really important because the Fed owns something like 1/3 of the agency mortgage-backed index that's part of the AGG. But in the TIPS market, too, there's this notion of a float adjustment. So if I look at a float adjusted index, I see a market value of about $1.25 trillion. And if I look at the index that isn't float adjusted, I see a little bit more than 1.7 trillion. And so that would imply to me 450 billion or so, maybe almost $500 billion, is owned by the Fed today. And of course, that adjusts periodically. These numbers might be a little stale, right? The market value of the index is adjusted and reweighted and all that. But they've participated in that market. It makes sense because if they're owning treasuries, these are also similar risk wise. They're not going to take on a lot more risk in the TIPS market in terms of default risk, as I would characterize it. There's different types of risk, but they're not taking on incremental default risk by investing in a part of the treasury market like TIPS, and they have taken more risk by investing in the agency mortgage-backed market. Although, if you think about those government-sponsored entities, Freddie Mac, Fannie Mae, and Ginnie Mae, that are one of those is owned by the government, I believe, or implicitly guaranteed or explicitly guaranteed. That would be Ginnie Mae, Fannie, and Freddie are in their conservatorship status. You could argue that there's limited credit risk there because of the backstop of the government, whether that's implicit or explicit. But when they started to stray into corporate bonds, they obviously started to take on credit risk. But they've been buying a lot of securities. The amount that they own is very large. Again, that's also publicly available data you can get from the Fed or other providers. It's over $6 trillion now, I believe. So they made their mark there, and that's a way for them to hold down yields and to support that market. And it's all around quantitative easing.
For anyone listening at home who doesn't have access to a Bloomberg machine, and obviously that's pretty high level information that you've shared. I do think the H41 or H.41 Fed balance sheet, you might at least point you in the direction. If you Google that, you might be able to pull up the Fed balance sheet. They do publish all as their activity in their reverse repo market of late as well. So I think that's the one, Marcel. I'm doing it from memory, but I think that's available online, but certainly not the information that you shared. So, well, Marcel, I think I said it was going to be more complicated, and I think it is. And I think the main things that, from our discussion today, I hope people take away is that there's a lot more to think about when it comes to TIPS bonds. And there's knowing where the risks are is always a good thing as well. And I think going through sort of the break-even rates and, is very helpful, and especially the duration. I'm glad, by the way, Marcel, you like my convexity example. I've been workshopping that for a little bit, and people seem to like it. So appreciate that, Marcel.
Yeah, I'd like to get back to Wrigley Field sometime soon.
Yeah. Is that your team? Are you a Cubs, or is that?
No, but it's always a wonderful experience going out to Wrigleyville. So and I'm more New York based, but I've been fortunate to go to a couple games out there, and it's always very, very enjoyable. So
I haven't been.
You brought back some memories.
I haven't been there in a. Yeah, no. I mean, I haven't been there in a while, and I know they put up some scoreboards and stuff, but I think I was there mid or late 2000s, probably, I don't know, 2007, 2008. And I just remember like sitting there, and it's like a scene out of The Natural. You see the pillars, and there's not a lot of scoreboards. Like, you're used to looking around at a stadium, and what a great setting though. You're right. So, all right, Marcel. Well, listen, thanks again. I'm going to link to, I'll put something in the show notes for State Street's fixed income products. You can find information. I'll put that link in there. I'll also link to the previous episode that Marcel and I did. Again, that was a masterclass on certainly high yield. We explored some other subjects in there, and this one, hopefully everybody gets, I think, a great education, and it was a great job by you, Marcel. So thanks again for coming on. I really appreciate it. And I think we might just have to have you back on a third time. This is such good information. So thanks again, Marcel.
I'd be delighted. Thank you so much for having me.
All right. We'll see everyone next week.